Hi friends, I'm back with one more video. This is going to be like very interesting video and very important video for all the option sellers, be it experienced or be it a new option seller. Okay, so so as the slide says, it's do's and don'ts for option seller. All right, I'll take to the next slide. So I have put my all experience, friends. I've put all my experience in terms of creating this PPT. So you'll not find any fancy PPT, but right, rather than me showing you practical and missing out anything, so I thought, why not to put everything, why not to jot it out all the points in the on the slide, so that uh, even I can ensure that I'm not missing any important points, and also this would act as a reference document for you. Okay, so now, so we have two sections. One is in the yellow color and the other thing is in the white color. So see, I do not have anything in the sequence, but I'll try to cover each and everything. Okay, see, first of all, be it a new trader, new option trader, or a experienced option trader, I would recommend you to go with, one second, to go with risk defined strategies. Yes, I know there will be some experienced traders, so they are pretty well, so they are pretty good at doing the adjustments for the strangle straddle, but still I would recommend naked risk defined strategies are far better than your naked strategies. I mean, you saw, right, yesterday we had almost 2.5% down all through this month. I'm not sure what is the news and everything. Is it the inflation or other thing? But we saw the trend. The Nifty is going down and down. So we have only one day at like 1%, and then the rest of the 4 days it is going down. And we have seen all the gap downs. In this scenario, I would say risk defined strategies are best, because end of the day capital is very important for us. So do not go for the naked strategies like straddle, strangle. Yes, if you're good at adjustments also, but market is very volatile nowadays. Okay, this is point number one. So I think especially for all the new traders, do not even think of going for naked strategies, meaning strangle, straddle, any strategy which has more selling legs than your buying legs, that is called a naked strategies, right? If you have two sell positions and one buy position, even that is a naked strategy. So there is a myth in market saying that if you have a buying position we are edge. No, it all depends the way you are edging. If you have two selling legs and if you have only one buying leg, obviously that is a naked strategy, provided that buying leg at the premium covers both your selling legs, so then we can say that is a edge strategy. But if you have two selling legs like 100 rupees and 100 rupees, and if you are going for edging, buying a leg only with 100 rupees, so then the remaining 100 rupees premium is your naked, right? End of the day that leg is naked, right? So you might end up into blowing up your capital. Second thing, do not copy paste standard strategies. So this is a common problem majority of the traders, even I did that mistake. See, Ironfly is not all about sell. I'll show you one example. Okay, I'll show you one example, friends. This is going to be like very interesting. See, Ironfly is not about always, we know this is Ironfly, right? So everyone, they will sell two at the money, PE and CE. So whatever premium they get, so they sell, they have the but edges at here. This is not the Ironfly, right? We should not copy paste. I mean, every YouTuber says that this is the Ironfly, we need to sell two, one put and sell. And if, let's say, if you got 500 premium at call side, 500 premium at P side, so we end up doing place, so we take the 1000 rupees edge, right? This is not the stand, this is not standard basically. Rather, you should deploy based on the view of the market. So I've made all the videos, friends. I'm not promoting my videos, but I'm just trying to help you. Each and every video, I think I've made all the videos. I'll do one thing, I'll just put it in the description box. So rather, you should go based on the market view and put your own thought process. Okay, let's say if you have a market, bullish market, right? So you can deploy something like this. Your market stands here, this is still your iron play, right? You are not buying any at the ATM, you are buying at a maybe 2 to 300 points at the OTM, so that even if market makes a good movement, right, you will still fall into your green zone, right? If you are bullish about the market, let's say if you are bearish, let's say if you are bearish about the market, right, you can deploy this iron fly. See, if I talk discussing about you have your market is here, so you have to go some OTM and just buy one PE and C. So even if the market falls, if it gives a moment of 1 to 2%, you will still end up getting profit. Right? I'm not going to discuss. I'm just giving you an example, saying that do not copy paste the standard strategies. You need to put your own thought process, and also you need to have the view of the market, friends. Without the view of the market, friends, it is very difficult for you to get profit in the market. See, I've made the very important notes. I thought of putting everything in here, but I would say, one second, I'll erase. I'll take. Okay, the other thing is like the rule book, right? You need to have the rule book. I mean, this sounds very kiddish, but you need to have the rule book. So what does your rule book define? Right, your rule book defines, okay, let me say, you need to have the rule book, right, wherein you should have all your plan A, B, C ready. See, whenever you're deploying any trade, be it your naked strategy, be it your risk defense strategy, you need to have your plan A, plan B, plan C ready with you. So whenever you have deployed, when I say whenever you're about to deploy, you have to have your three plans ready, meaning what plan you need to execute if the view goes against you, what plan you need to execute if the view is going in line to your view, right? Sorry, if the trade is going in line to your, so what plan you need to execute if the market is in between your view, meaning, right, I mean, you got my point, right? So whenever it goes against your view, you need to have your plan ready. If it is not going against view, you need to have ready, and you even need to have a plan C. Okay, so without having this plan A, B, C, this is not the end, right? A, B, C, C adjustments are very dynamic, right? So you need to have all the plans ready. So whenever you deploy Ironfly, right, I'll tell an example. You deployed the Ironfly, market was in the center. Let's say next day market gap up 3% or 4%, or the next day the market has gapped down 3-4%. When you should not even think, this should be a plan C, saying, meaning exit the trade, that's it, exit the entire trade with loss. Do not even go for firefighting. If you're still going for firefighting, that will show that you are a very newbie to the market and you do not know how to tackle the market. That's it. See, 3% gap done, why the hell you will do the firefighting? Exit the trade, and by the time your market comes 3%, your VIX will increase, right? VIX will increase. So why don't you deploy a new Ironfly? Take a break, or if you're an aggressive trader, deploy a new Ironfly at that moment, because you'll get good premium. You will get good premium at that moment. So this is your plan C. So let's say you deployed a Ironfly. Okay, let's say market goes breached your break even, you should have your plan B ready, right? Let's say market breached, came to your P side break in, you should have your plan ready. You should not think at that time, because even a 5 minutes candle can just draw down your capital 5 or 10. Yesterday we saw the market, right, within like 30 or 1 hour, we saw like 1 or 1.5% of gap down movement. Okay, and let's say you have a iron fly, right? Right, let's say you have an iron fly, next day market stands in the between. You need to have your plan A ready, in terms of getting your edges inside, in terms of getting your edges inside, right? I mean, there are a lot of adjustments, so you need to have that rule book. This is very important. You need to have that rule book, wherein you have to mention each and every point. It should have your plan A, plan B in advance. That rule book should define the position sizing, friends. Position sizing is very, very, very important. So let's say you have a capital of 1,05,000, 1,50,000, right? You should select the iron fly based on your capital. Don't blindly go. If you have like 1.2, don't go for 3 lots. I know one lot will take 50,000, right? Remaining 1 lakh you have to keep it for adjustments. You cannot deploy 3 lots of iron fly and you do not have any margin. See, that's what I've maintained here. Margin for adjustments. You need to have margin for adjustments. Any iron fly or any strategy, you need to have the margin. Let's say you have 100%, right? Deploy only 40% into your trade, and the remaining 60% should be on your adjustments, because in this current volatile market, adjustments are very important. So have some money for your adjustments. Do not deploy your entire capital into any trade. You have to have your uh, what do we say, you have to have your capital. One second, friends. Where is the eraser? Right, that's what I mean to say. You need to have the extra margin for your adjustment. That's what I mean to say. Rule book, see, I can make one hour video for the rule book, but just I'm giving you a very high level, right? You need to have plan A, B, C ready in advance. You need to know your position sizing. You have to keep your extra margin for adjustments. I know many of the retailers, many of the option traders, they will not follow this rule. Okay, market view is must, friends. Without the market view, I mean, you don't even dare to go for any option strategies. Do not predict the market, but you need to know the market view, right? You need to know the market view. Chart, you can go for chart analysis, you can combine it with OI, and also you can combine it with FIS. These are the three things what I follow, right? Chart analysis plays like 80% for me, OI 10%, and FIS like 10 to 15%. And based on the view, you need to select your strikes, what we have discussed. Do not blindly copy paste the standard strategies from others, right? You need to select the strikes and the premiums according to the chart, according to the open interest, and according to the FI. Let's say on a chart you see some one strike as a very critical support, right? So then you select, you go for the buying on the PE side by selecting that particular strike, or just you go 100 points below that point. If you find any good strike with a very good OI built up on the call side, right, on the call side, whenever you go for the buying edge, you can just buy that leg, buy that strike, or else you can just go 100 as a defensive, right? You need to select the strikes premiums according to the market view. Okay, then let's let me come back to, right, right, VIX based strategies do not deploy if you are not aware of what strategies you need to deploy when the VIX stands, right. You are doing something very wrong, right? You should not deploy an iron fly when the VIX stands at 10. See, I'm telling you, cannot deploy a iron fly, right? You cannot deploy a iron fly when the VIX is standing at 10, right? VIX standing at 10, you will have very less premium. So what you're expecting from the iron fly? So you have to deploy your iron fly when the VIX stands between 18 or greater than 18. You have to deploy the iron fly, right? You cannot deploy a iron fly when your VIX stands at 25, right? Maybe VIX will come down. What does iron fly, sorry, what I mean to say, you cannot deploy your calendar at when the VIX is 25. So maybe the I potential is, I probability is VIX will come down, right? That will give you a loss. You cannot deploy the iron fly when your VIX is 10, because VIX will keep increasing. Iron fly requires the falling VIX, not the rising VIX. I'm not going to discuss anything. I've made a very good video that is almost like Bible for all the option sellers. You can watch this video, or else I'll put it into the iCard. You can just check out the iCard, or else I'll put all the videos into my description. And you should be very good at identifying like what strategies you need to deploy when the price it at the support and resistance. I mean, this is one of the bare minimum, friends. This is one of the bare minimum. So let's say your price stands at support, right? If you are planning to go for an iron fly here, you will definitely end up losing, because this is a support, right? Price will go up, right? We need sideways market, not the momentum market for your, what do we say, for iron fly. Let's say the market stands here. If you go for iron fly, that's a wrong strategy, because for market will fall down. We need let's say the market is giving a breakout. If you're planning for iron fly here, that's the biggest mistake you're doing, because at the breakout you'll have bigger moves, right? That will give loss to your iron fly. Same thing, let's say if market is giving down movement, breakdown, you should not deploy your iron fly. Just taking an example of iron fly, it can be anything. The best thing would be, whenever the stock is at here, you have to go for debit spread. Whenever the market is about to give the breakout, you have to go for debit spread. You can go for ratio spread, right? You have to go for all your non-directional whenever the market stands in between of the parallel. So because market has a potential to go up, or the market has a potential to go down, so this is your straddle, right? If you want to make this triangle, you can just make it to triangle also. See, I've already mentioned each and everything so I've made a video on this one, and even I made a video on based on support and resistance. I would want you to watch that video. All right, what is the next point? Edge is not a stop loss. I mean, there is a myth in market saying that. See, I'll tell you one thing. Okay, I'll show you one example. See, we have this iron fly, so we have this, both these edges are not the stop loss. If you look at this 8,648, do you think on a capital of 14,000 you are putting 20 to 25% of the loss, No, right? I mean, this is almost 25, but this is the edge. I mean, this is there to protect you from black swan events. Like if the market makes 10%, 20% gap down, that's where it helps you. But this is not the stop loss. You need to have your own stop loss in your mind, or you need to keep somewhere in your trading system. This is not the stop loss. The edges are not the stop loss. The two edges are not stop loss. Stop loss should be only 1% or at max 2% or at max 3% on the your capital deployed. So let's say you're deploying, see that's what, let's say you're deploying 41,000 and you're keeping 1 lakh as a margin, right? 1 lakh as a margin. So what is 1% on 1 lakh? 1,500. At max 3,000 or 3,500 should be your stop loss. I would rather say only 2%, right? Which is your 2,000 should be a stop loss, not 8,648. Try to understand, friends. Edges are not stop loss, right? I'm not going to, because I wanted to make this small. Edges are not stop loss. Edges are only to give you protection in case of, right, bigger gap downs. Have realistic profit. This is very important. Have realistic profit. Don't go on the payoff profit. Meaning, see, if you're looking at 16,335 when you're deploying 1,50,000, because this is 41,000 your iron fly, but you need to put your 1 lakh as an adjustment. So overall on the 1 lakh, if you're expecting 16,353 profit, 16,350, then then you're doing something very wrong. You're treating market as a gambling, because on a capital of 1,50,000, even if you get 1,500, which is 1%, or else if you get 2%, 3,000 somewhere, even the moment you deploy the trade, the very next moment you see like 1,500 to 2,000 profit, exit the trade with profit. That's it. Don't even expect for more profit, because you need to have very realistic profit. I mean, all the successful trader will have 1% per week, which is 4% per month, which is like almost like 50% per year. If you are expecting 1,000%, 200%, then you're doing something gambling. So do not go on this profit. Already I've made all the videos in my playlist, right? Do not go on this profit. Rather, 40,000 plus 1 lakh, right? 50,000, 1 lakh 50,000. So the moment you find 1% to 2%, that is like 1,500 to 3,500, 3,000 profit, exit the entire trade. That's what I'm trying to. This is very important. I'm not sure whether all the retailers will follow this, but if you do not follow this part, I think you are treating market as a gambling. So you will not sustain in the market for sure. You will get out of the market. Don't go as the payoff profit. Let me quickly give it a checkpoint. Okay, 17 minutes. So friends, I'll do one thing. I'll stop after 3 minutes and then I'll make one more video. Okay, because at times the videos are getting stuck. Okay, exit the trade. This is very important. Exit the trade the moment your target. So that's what I'm telling, right? And see, this one we forgot, right? We have discussed. You should know when to deploy directional trades, when to deploy non-directional trade. I've made 3 parts videos, friends. I mean, that is very interesting video, right? How to deploy your trade based on the support and resistance, right? I made 3 parts, right? 20 minutes each. That would be a Bible. Sorry to use the word Bible, but I'm just using it on the right way. That would be a Bible or Quran or Bhagavad Gita for all the option sellers. Believe me, right? You should know when to go for directional trade. You cannot go for directional trade when the market stands here. If you go for the directional trade, yes, if you go for the moment upside, if it goes downside, you'll have huge loss. You have to bear like 5% loss. You have to go for non-directional trade when your market stands in between the parallel channel or in between your triangle pattern, right? This is, I've made a 60 minutes video. Please watch it in your leisure time. Okay, exit the trade the moment your stop loss or your target is it. That's it. Your entry, your target, your stop loss, that's it. Whenever you enter, you have to exit your trade the moment your target is it, or the moment your stop loss is. That's it. You don't even give it a thought. Just exit the entire trade and then you do the analysis. What went wrong? Is it the market which made you to the exit with the volatile moment, or you did some blunder mistake? Do the analysis, and based on the learnings, right, you end of the day, market will teach you. Either market will teach you, or else you should learn from your own mistakes. For every trade, do the analysis, do the backward compatibility analysis. So where did I started my trade? I started my trade, what adjustments I've done, have I done the right adjustments, right, or wrong adjustments? You have to review your trade, right, whenever from your deployment till your closure. All right. What did I say? Right exit. So friends, I'll do one thing. I'll just pause this video. I'll stop this video and I'll make one more video right away. All right. Thank you.